Hello, greetings from the Zambia Institute for Policy Analysis and Research. My name is Nakubiana Mungomba, and I am in the Macroeconomics unit here at ZIPAR. And just a bit of an introduction to our institution. We are a quasi-government think tank, which has the mandate of conducting policy analysis and research for our stakeholders, which include the government, the private sector, and civil society organizations. But the reason we're all here today is to support the launch of the OECD Multilateral Development Finance 2020 report, which was launched on 26th October. And essentially that report is what the OECD has decided to do this time is to carry out events around the world, which are being televised around the launch of the report and giving different perspectives of what interpretations of that report. So as ZIPAR, we are going to take a bit of a unique view and look at how multilateral development finance relates in the Zambian context. We have an interesting lineup of presenters who are going to share a few different perspectives with you today. But first, I would like to play for you the opening remarks of the Secretary General of the OECD, Angel Gurria, and just to give you a context of the report.
Ladies and gentlemen, I am happy to launch OECD's Multilateral Development Finance 2020 report. As we face the most profound global health, economic, and social emergency in the history of the multilateral system, this report highlights the importance of restoring trust. Trust among nations, trust among people, trust in the governments and the institutions that people look to defend their rights, to protect them in the face of the pandemic and its dire economic and social consequences. Trust in multilateralism in the post-COVID world. Development finance is paramount in helping us achieve a fairer and more resilient recovery. Important progress has been achieved. For example, a large part of the financing made immediately available to developing countries at the beginning of the pandemic was channeled through the multilateral system. Multilateral organizations provided nearly $250 billion in immediate relief assistance, compared to $5.5 billion by bilateral donors. The report also shows that multilateral organizations can generate greater economies of scale, have a better presence in fragile contexts, and tend to work more closely with partner governments than bilateral donors. Nevertheless, numerous challenges exist, which are being compounded by the COVID-19 crisis. While the absolute volume of funding for multilateral organizations is growing, actually, core funding is declining. Between 2000 and 2018, the share of earmarked contributions in total multilateral funding rose by 29 percentage points, from 6 to 35%. In consequence, we are increasingly moving towards a system where ad hoc alliances between a handful of member countries determine the multilateral agenda. Now, several organizations display a high funding vulnerability, with a highly concentrated donor base. Looking ahead, we need a multilateral system that brings governments together around hard facts, equipped with the right tools and expertise, and with a shared resolve to move forward and keep the 2030 agenda alive and within reach. Our latest Multilateral Development Finance report puts forward a number of recommendations focusing on tackling these challenges and helping us achieve the Sustainable Development Goals, the SDGs. Now, let me briefly highlight 3 of these recommendations. First, use the momentum generated by the COVID-19 crisis to increase DAC members' level of official development assistance, including their financial contributions to multilateral organizations. Second, ensure that financial contributions to multilateral organizations provide them with sufficient independence and flexibility. And last but not least, enhance accountability in order to restore trust in the multilateral development system. Now, this will require better communication of its results and of its impacts, as well as ensuring a transparent and effective division of labor. So, ladies and gentlemen, development finance is paramount for our global efforts to keep development on the right track, to keep countries that now need your support more than ever before. So be generous, be smart. Thank you.
Okay, so those were the opening remarks from the reports. And essentially, this year, the report is really coming out at a time when we are entering the decade of action in terms of achieving the Agenda 2030. So what our presentations are going to do here at ZIPAR is to share with you the Zambian perspective, as I mentioned a little earlier, and we've got 3 presentations lined up for you. Our first presenter is going to be Mr. Ignatius Masilokwa, and he is in the Macroeconomics unit here at ZIPAR. He is going to present a macroeconomic perspective of multilateral development finance in Zambia as it relates to growth and debt. So, Ignatius, over to you.
Thank you, Nakuviana, for that introduction. So, like Nakuviana mentioned, I'm going to present on Zambia's macroeconomic and debt situation and what role the MDF can play in this situation. First of all, we're going to start with the outline of the presentation. So amongst the issues that I'm going to talk about, there will be the introduction to see how Zambia has evolved in terms of growth. Thereafter, I will speak to the reclassification of Zambia from low-income country to lower middle-income country and what that entails for Zambia. Thereafter, we will discuss the role of MDF in Zambia's debt situation. And finally, I shall discuss some issues that Zambia would need to address in order to harness or benefit from this possible support from the Multilateral Development Finance. Okay, so Zambia in 2011 attained the status of a lower middle income country. This was after recording GDP growth of about 7.4% per year. And at the same time, Zambia managed to cross the lower middle income country boundary of 1,600 US dollars, 1,060 US dollars GNP per capita to jump into that threshold of lower middle income country. However, a few years down the line, in 2015, the country started experiencing some macroeconomic instabilities, which led to reduced economic growth. And economic growth has been declining ever since. Fast forward to 2019, 2020, the COVID-19 pandemic has only made the macroeconomic problems worse for Zambia, with Zambia's macroeconomic growth, or Zambia's GDP growth, estimated to contract by 4.2% in 2020. A bit of a background where the country is coming from. In the 2000, between 2000 and 2010, the country benefited from two initiatives. The first was the heavily indebted poor countries, which is the HIPI completion point. After the HIPI completion point, most of Zambia's debt was significantly reduced. Other than the HIPI completion point, the country also benefited from the Multilateral Debt Relief Initiative. However, in 2011, going forward, the country adopted expansionary fiscal policies. The fiscal policies were motivated by the need for infrastructure growth. Infrastructure growth demanded expenditure, which unfortunately the government did not have, which could not be sustained by domestic revenue, which led to borrowing, and borrowing from different sources. Those sources will be discussed in the slides to follow. As you can see in the slide, if you look to the right, you see how Zambia's debt composition changes between 2008 to 2019. Remember, Zambia was reclassified to lower middle income country. That meant that it was ineligible to access some of the concessional finances which were being offered by the Multilateral Development Finance, but at the same time it qualified for other sources of finance, such as international debt market. At that point, Zambia started issuing out Eurobonds, and at the moment it's issued 3 Eurobonds, which has significantly increased Zambia's external debt composition, especially the commercial component. If you see the red in the graph, that shows you how that component, the commercial debt component, has increased over time, whereas multilateral as well as bilateral debt has remained significantly low in Zambia's debt composition. Going forward, we see that external debt has significantly increased and is at 66% of GDP. This has increased Zambia's interest payments in terms of debt. Interest payments have increased significantly, and these interest payments would have to be made in US dollars. So there are all those exchange rate pressures that come with the depreciation of the kwacha. And furthermore, the rapid increase in Zambia's debt has made it difficult for Zambia to get on an IMF program, because the IMF is not convinced that Zambia is doing enough to move towards debt sustainability levels. And what this increased debt has done also is the crowding out of other critical sectors such as health, critical sectors such as education, and other sectors that we need to drive Zambia's economic growth. With the coming of the COVID-19, the situation has only gotten worse. However, the Multilateral Development Finance has in stock quite a number of options which the country can benefit from. One of the options is the Rapid Credit Facility. The other one is the Rapid Financing Instrument. But for Zambia to access any of these two options, Zambia would have to be subjected to debt sustainability conditionalities. It has to work on its debt levels. It has to make efforts to reduce debt towards sustainable levels. In addition to these two options that are coming from the IMF, the Africa Development Bank also has in stock options that can help Zambia in the COVID times to help the country manage the macroeconomic pressures that COVID-19 has come with. But also, to access this facility as well, the country would have to be subjected to debt sustainability conditionalities. So we can see that debt sustainability is of paramount importance to Zambia's access to all these facilities that are available. So how essential is the multilateral development finance in Zambia's situation? Well, for starters, through the IMF, Zambia can benefit immensely. Immensely in the sense that on Zambia's debt composition, Eurobonds are the most expensive and are taking up much of Zambia's fiscal space. With the coming of the IMF support, an IMF support can create the much needed fiscal space which can allow Zambia to spend in other critical sectors which are otherwise being crowded out. Other than that, the IMF comes with technical assistance such as a staff monitoring program that can help Zambia to improve its accountability as well as transparency in handling its debt. And finally, an IMF program would actually open more doors to other multilateral development finance, such as the Africa Development Bank, the World Bank, and many others. So what should Zambia do to receive this support? Zambia needs to rebuild its credit worthiness, especially on the international stage. To do this, the country has to prove that it's making or taking prior actions to enhance its fiscal as well as debt management. The government has to also strengthen institutional oversight over borrowing. And this speaks to the debt management that I have repeatedly alluded to. One of the ways the government can do this could be through insulating of public institutions that monitor, support, and execute the spending. Finally, one other thing that the government can do in such a situation would be to provide a legal or legislative reforms that address the gaps and the weaknesses in the legal framework, such as revising the loans as well as the Guarantees Acts. Thank you.
Thanks so much for that presentation, Ignatius, and giving us a broad overview, particularly about how the IMF can play an important role in sort of stabilizing Zambia's macroeconomic situation in terms of multilateral development finance. Up next, our presenter is Mr. Shimkunku Manchinshi, and he, as I mentioned earlier, is in the Trade and Investment Unit and will be talking about the economic growth drivers and how development finance can assist with that.
Thank you very much, Nana, and thank you, Ignatius, for setting the tone for what we are looking at today. My presentation is focusing on the role of multilateral development finance in Zambia's growth agenda. So in terms of the outline of my presentation, firstly, I'll look at the rationale for multilateral development finance, and then I'll move on to Zambia's growth story, after which I'll look at GDP growth trend that has taken place in Zambia over time. Then I'll look at GDP growth contribution by sectors in Zambia, and then I'll move on to the shrinking fiscal space that Ignatius already alluded to, and then I'll talk about the impact of COVID-19 on Zambia's key growth sectors, and then conclude by looking at the role of multilateral development finance in Zambia's growth story. So what can multilateral development finance do to be able to aid growth? Now, for starters, the rationale for multilateral development finance is basically premised on the argument that economic transformation requires long-term investment to be able to support the expansion of productive sectors as well as infrastructure development. Now, we understand that multilateral development finances have been a feature of the development finance architecture for many years. So this became very evident after the First and Second World War, where we saw the growing role of the World Bank and the International Monetary Fund, in addition to other multilateral development financiers. Now, multilateral development finance institutions play a key role in providing long-term finance and also funding global and regional public goods. Now, in terms of Zambia's growth story, what we notice is that Zambia's economic growth story is emblematic. It's emblematic of the resource scarce phenomenon, where countries that are endowed with a particular resource do not seem to expand or diversify into other sectors. Now, in many ways, Zambia is a mono-economy that is reliant on the export of copper, which accounts for about 70% of our export earnings. Now, diversification remains an elusive goal, even though it is well stated in many policy documents. Now, in recent years, Zambia's growth has contracted, And this is on account of drought due to severe weather conditions, and this has had knock-on effects on the agriculture and energy sectors. And we've also seen poor performance in the mining sector due in part to low copper prices, low copper output, and at some point changing fiscal policies by the government. Now, government's medium-term strategy for inclusive growth is well stated in the 7th National Development Plan, which has identified growth sectors that can drive the economy, and these are tourism, mining, energy, and agriculture. The 7th NDP has also identified enablers of growth, and these are infrastructure, access to markets, and information and communication technologies. However, the COVID-19 pandemic has basically worsened an already ailing economy, and I will show this in my next slide. Now, when you look at the slides that I've beamed, you notice that Zambia's growth over time, if we look at the period 2000 to 2019 and what is projected for growth in terms of 2020 and 2021, we've been sliding downwards from 2010, and this is something that Ignatius elaborated very well earlier on. And we also look at GDP per capita growth, which has been sliding in similar terms from 2010. So what I'm trying to state here is that the COVID-19 pandemic has basically worsened a trend that has been there over time. Now, if we look at the sectors that have driven growth for Zambia in the past few years, looking at the graph that I've beamed, you notice that information and communication technologies, the services sector under financial and insurance services, as well as mining, have been driving growth in the country for the past 10 years or so. We also see the importance of the construction sector, which has recorded positive growth over time, and this is evident when you look at the infrastructure drive that the government has embarked on. Now, moving on, when we look at the spending in terms of the diversification and economic growth drive, one thing we notice is that there's been shrinking fiscal space in terms of what the government is able to expend. So due to borrowing, which has been alluded to, Zambia is now facing a challenge in terms of what the government can spend on the growth sectors. So what we see in the graph that I've beamed is that over time, the debt servicing costs have been growing, and this is in addition to the wage bill. So what remains in terms of what government can spend on growth sectors has been shrinking. In 2020, in the first half, what we saw is that government only had 15% to be able to spend on the growth sectors, and this trend has been very evident since 2017, where the space that government has to be able to expend on growth sectors has been reducing. And then we also use economic affairs in the budget to proxy spending on economic growth and diversification. So under the economic affairs heading, we find spending, for instance, to agriculture and other growth sectors. So what you see in the graph there is that from 2017, there's been a reduction, a very gradual and consistent reduction in terms of what government is spending on economic affairs. And this just goes to illustrate the shrinking fiscal space and how growth is being impacted by debt servicing costs. Now, moving on to the impact of COVID-19 on key sectors, what we notice if we do a comparison of growth in the first quarter of 2019 and the first quarter of 2020 is that certain sectors have definitely suffered, and these include tourism, which we proxy by arts and recreation, as well as accommodation and food. What we notice in the graph is that there's been a drastic impact in terms of the sector's growth prospects. Some sectors, of course, could have survived, and this is shown in the graph where you see agriculture has posted some positive growth, and this is good due to the good weather patterns that have been recorded in the previous season. So generally what we see is that there are some sectors that have suffered the effects of COVID-19 while others have benefited. Moving on to a comparison between quarter 2 of 2019 and quarter 2 of 2020, again we notice a trend where tourism has been hardest hit. Information and communication technologies have definitely benefited from the COVID-19 pandemic, and this is evident from the number of initiatives that have been taking place to be able to make sure that we use information and communication technologies. Now, moving on to the gist of why we are making these presentations, the role of multilateral development finance in Zambia. So what can these multilateral development finance institutions do to be able to promote growth in Zambia? Within the context of the report that has been produced by the OECD, we note that there are long-standing issues for a country like Zambia that need to be addressed. So in terms of funding, the priorities should be firstly in improving production and productivity, especially in the agriculture sector. So we noticed that the agriculture sector has huge benefits for the country in terms of employment creation. So if we're able to improve the productivity in the sector, that will augur well for the country in terms of export capacities. Then the next issue has to do with provision of affordable finance. So access to credit remains a big challenge in the Zambian business environment. So there's need for multilateral development finance to bridge this gap and be able to provide affordable finance to people in various sectors. Then the next issue has to do with initiatives aimed at reducing regulatory burden. So for instance, in the tourism sector, we have an issue where people have to adhere to multiplicity of licenses. So what multilateral development finance can do to be able to promote growth in this sector is to ensure that there is a reduction in the number of licenses that are required. Then we can also ensure that there's support towards alternative energy sources, and this is something that the World Bank, for instance, has done over time. They funded the Kariba North Bank power station, and they've continued to be able to support initiatives, for instance, in solar. So this is a very important space for multilateral development finance, and we can have many more players to ensure that Zambia diversifies its energy sources. Then lastly, in terms of tourism, we can also look at tourism-related infrastructure. So the 7 NDP, which is Zambia's guiding document for growth, looks at promotion of tourism in the northern circuit. So one of the things that multilateral development finance institutions can do is to fund initiatives aimed at building and improving infrastructure in untapped areas for tourism. Now, some things that we note and agree with in the OECD report for 2020 in terms of multilateral development finance. Firstly, there's need to ensure that the multilateral system can help address challenges that are new in nature, and the COVID-19 pandemic is a prime example of how the world is now vulnerable to these crises over time. So there's need for multilateral development finance to always have this in mind and to have proper plans in place to ensure that we're able to respond to crises like the COVID-19 pandemic. So we've seen the impact that it's had on global growth as well as growth at country level. So going forward, there's need for institutions to always have in mind the possibility of events like this happening and to put in place mechanisms so that we reduce the risks that arise. Then next we have something that we noted in the report is the need for efficiency to be able to demonstrate value for money in the context of constrained resources. So one of the issues that needs to be sorted out is a multiplicity of funding. So what we notice is that there are a number of multilateral development finance institutions that are in the same space, basically funding the same project. So what needs to happen going forward is to ensure value for money and that discussions take place among these institutions to ensure that there's no multiplicity of efforts and thereby promoting efficiency. Then there's also a need for support towards a green and resilient system at the global level that will promote recovery from COVID-19. So climate change is a big issue, and for least developed countries like Zambia, there's need for support to ensure that we're able to adapt and mitigate the effects of climate change. So going forward, this is a big concern that multilateral development finance institutions need to consider in order to foster growth. Then lastly, there's need for the development of an analytical framework to ensure that there's an assessment of the selectivity of multilateral organizations' operations. So this entails a situation where there's need for prioritization of efforts towards countries that actually need help. So we've seen from COVID-19, for instance, that LDCs like Zambia definitely need help. So as we go forward, there's need for prioritizing and basically being selective in support that is given to countries to ensure that only those that really require funding and assistance are prioritized and given this sort of help. Thank you very much.
Thank you so much, Chimu, for really breaking it down in terms of the effects that, for example, the COVID-19 pandemic has had on the Zambian economy, and really explaining to us how multilateral development finance can come in to help with not only recovery from COVID-19, but even just looking at where we're coming from and the different ways that we have been trying to improve our economic growth strategies, and the role that multilateral development finance can play in that regard. So taking it another direction towards the social sector, and moving away from the sort of macro level economic growth aspects, we have Mr. Miselo Walia, who is going to share with us a presentation about how multilateral development finance has sort of worked in the social sector space in Zambia. Miselo, over to you. Thank you.
Thank you so much, Nakubiana. My presentation will focus on the role that multilateral development finance can play in fostering social protection in Zambia. A specific focus will be done on the Zambia Social Cash Transfer Scheme, and this is a scheme that basically has had a long relationship with donors here in Zambia. So just to take you through my presentation, I'll provide a background, I'll look at some of the challenges we've had in implementing this particular scheme. We'll also look at our pre-COVID economic context and what this means for social protection in Zambia, as well as some of the potential risks that we've had due to COVID and the response of cooperating partners in providing support in this particular sector, and we'll end with some recommendations. So to start with, Zambia's Social Cash Transfer Scheme started in 2003, and from inception, we had cooperating partners supporting this particular endeavor. In 2003, when the scheme started, we had 3,500 beneficiaries. By 2020, this number had risen to a targeted 700,000 beneficiaries. And next year, in 2021, the number of beneficiaries is expected to rise to over 990,000. There's also been quite a number of changes with this particular scheme. For example, when it first started, beneficiaries were receiving 40 kwacha in 2003. This gradually increased to 90 kwacha, and next year, 2021, this amount is expected to increase to 110 kwacha. So like I earlier mentioned, this is a program that's received a lot of support, MDF support, both financial and technical. When the program first started, it was largely driven by external support, that is MDF. When we look at this program, by 2009, the government was only contributing 5% towards this program. Currently, the ratios and the responsibility that government has taken has sort of improved, and now we have a ratio of about 75% coming from government, while MDF or donors contribute 25% towards this particular program. I'll also get into some of the challenges, and these are important to understand as we get into basically discussing the role that MDF can play. One of the significant challenges that we've had with regards to implementing the social cash transfer scheme in Zambia has been basically accountability concerns that have been raised throughout the program. In 2018, an implementing partner here in Zambia, the Zambia Postal Services, known as ZAMPOST, basically diverted 41 million kwacha that was meant for implementation of this program. This led to very significant concerns from partners that were providing support to this particular program. We also look at other challenges such as the amounts remaining static, and this has really affected the plight of beneficiaries, as the amount has only been revised 3 times, like I earlier mentioned in my introduction, in a period of about 17 years. Other issues have also been with the targeting of the program. An audit done between 2013 and 2017 revealed that 3% of the beneficiaries on this particular program were ineligible. Other challenges of this program have also included the high administration costs. Another audit done between 2014 and 2017 revealed that the administration costs for the program were as high as 42%. This was above the acceptable 15 to 20% that was agreed between government and supporting partners, which include donors. Other significant challenges of this program have been the irregular disbursements. Part of the challenges have been government delaying to disperse monies to the actual implementing districts or spending agencies. The same audit between 2013 and 2017 revealed that delays in disbursements ranged from anywhere between 8 days to up to 11 months. this causing significant challenges in the amounts of monies or the times that beneficiaries are expected to receive these particular monies. Further, we also had significant challenges in terms of budget outturn. Like I earlier mentioned, at the turn of the decade, the government had taken up the program, basically providing up to 75% financing for the program. And when you look at the period 2015 to 2019, only 46% of what was committed by government was actually disbursed towards the social cash transfer. This translated into significant challenges in implementing this particular program. Now, pre-COVID, Zambia was already going through significant economic challenges. Both my colleagues have alluded to this. In the first slide, basically on our graph, it just shows the shrinking fiscal space. This basically just looks at the proportion of domestic revenue that is available for expenditure once government basically expends its non-discretionary expenditure. So non-discretionary expenditure here is basically debt services and personal emoluments. In 2019, only 13% was available. 2020, you had only 17% available for all economic activities of government, which includes social programs like the social cash transfer. And in 2021, we see that there's completely no space left for this particular program. Like I earlier alluded to, we also look at what the outturn has been for the social cash transfer. Going out from 2016 to about 2020, which is 2020 as of August, you see that 90% of what was committed had not been disbursed, and this is almost into the final quarter of the year. This sort of gives a challenge on how difficult it has been to finance social programs, and this now gives a proper need for this particular program to receive significant support from partners through MDF. Now, throughout the year, Zambia, and as colleagues have alluded to earlier, Zambia has also gone through a phase of COVID-19 challenges. Of course, the health implications have not been as high, but the social economic implications have been quite significant, and this poses quite significant risks. One of these risks that we expect to see with this particular program is increased vulnerability amongst households, and this will most likely lead to an increase in the number of households that are in need of the program. So potentially an expansion in terms of people that qualify for this particular program. We also see a potential reduction in funding. As my colleagues have earlier alluded to, 2020, the economy is projected to grow at -4.2, and this will obviously affect available funds to implement this particular program that is quite key in reducing vulnerability amongst poor households in Zambia. We also expect that there could be delays in the implementation of this particular program due to COVID-19 enforcement measures. Of course, you have measures such as working from home, staff rotation policies, bans of gatherings, and these could have a potential implications or an impact on basically the implementation of this particular program. Secondly, as we've seen, due to COVID-19, households have faced different costs. Some of these costs have been facing higher hygiene and health-related costs. They need to purchase water, they need to purchase soaps that are required in preventing or prevention of COVID-19. And so basically, what you would anticipate from this particular program is there could be a possible erosion of the actual benefits or transfers reduced or received by households due to this particular pandemic. So basically, we also look at what multilateral partners have done. Like I earlier alluded to, the contribution over time has reduced to 25%, but we have still had a response. In July 2020, partners that have included UNICEF, the International Labour Organization, the World Food Programme, UNDP, and other partners launched what is known as the COVID-19 Emergency Cash Transfer. The transfer is basically being done or targeting 22 districts, mostly urban, and this is because it is anticipated that the socioeconomic impacts of COVID-19 will basically be felt more in urban households. So they're basically targeting 258,000 households. A key change from this particular program is that the monthly transfers are pegged at 400 kwacha, which is almost or more than 4 times what is currently provided under the traditional social cash transfer scheme. This scheme is expected to last for about 6 months, and payments are being made directly to households through mobile money, so through mobile network operators. Payments are expected to be made either bi-monthly or tri-monthly, depending on the different operating agency. However, cooperating partners or development partners here in Zambia have also taken up different roles to try to support the implementation of this particular program. Given the background of limited finances, the impacts of COVID, and possibly going into a recession, it means there will be limited resources available. What this means then is that we need to use resources more efficiently, and this is where our partners can play quite a significant role. Some of the ongoing interventions have been the development of a targeting tool. This particular effort is supported by the Food Agriculture Organization. Like I earlier mentioned in my introduction, one of the challenges of the social cash transfer scheme has been the targeting, and this has been seen through the presence of ineligible beneficiaries on the program. Developing this particular tool will help reduce the presence of ineligible beneficiaries, but also ensure that this particular program targets only those that are in need. Another significant development that partners have supported is the development of basically a cash plus program, which basically looks at supplementing the social cash transfer with other items apart from the transfers that are received by households. So these supplementary programs could be bursaries, providing households with livestock, and other interventions deemed fit. This particular activity is being supported by the ILO, UNICEF, Food Agriculture Organization, UNUIDA, as well as ZIPAR ourselves are part of the technical team trying to provide these. These are basically interventions that already show the sort of support that cooperating partners can provide, both financial and technical, in trying to ensure that programs such as the social cash transfer, which are critical in providing social protection and protecting the vulnerable, especially in these times of COVID and an economic recession, to ensure that resources are used efficiently. So finally, we get into our recommendations, things or ideally identified interventions that ZIPAR is confident once implemented could play quite a significant role in improving the efficiency. And this is also a role in which cooperating partners can basically support. The first one, like I earlier mentioned, activities that are ongoing, is basically to support the improvement of targeting for social protection programs. This basically involves improving or developing targeting tools that improve or contribute to improving the targeting. The second one is to come up with efficient methods to ensure that administrative costs are significantly reduced. One of these things are lessons that we can learn from the emergency cash transfer, which basically provides households directly with these transfers. This basically cuts out a lot of administration that is done at either the provincial or district levels, and basically will help reduce the administration costs, making this particular program more efficient. This also leads to the final recommendation we have. What we learned from the emergency cash transfer, which is being supported by donors, is that there is also a need to improve transparency. Like I earlier mentioned, in some of the challenges that we faced in this particular program has been the limited transparency, and this also was seen by the diversion or the misapplication of funds, particularly led to donors reducing significant support towards this program and opting to intervene or implement their programs directly with households than through government. So basically, the final recommendation is that there is need, firstly, from the government to develop mechanisms and to receive support in terms of technical support from our donors and financial support in improving the mechanisms that will improve transparency, and this will ensure that money is being used, also efficiently used, but also instill confidence in partners that are basically supporting and providing finances for this particular program. Thank you very much.
Thank you so much, Ms. Ella, for that presentation, and really bring us down to the grassroots, I suppose, in terms of the way that cooperating partners can really affect people's lives and livelihoods on the ground. So you were talking about, say, 110 kwacha, which the social cash transfer has increased to this year, I believe, and that translates to about $5 to $6. So in international terms, it may not seem like a lot, but I think for the people who are receiving those funds, that's the difference between, poverty and some sense of comfortability. So thank you for that, and sort of explaining all of those different aspects, and particularly as they relate to the effects of COVID-19 and also development finance. So everyone, that is the end of our presentations, which we have prepared for you. But I was just having a couple of thoughts as the gentleman was speaking. And if we look at the MDF report, which the OECD has launched just this month, it is talking about working towards the Agenda 2030 for sustainable development. In Zambia, we have our own sort of Vision 2030, and it is to achieve a prosperous middle-income country by the year, to make Zambia a prosperous middle-income country by the year 2030. So, gentlemen, do you have any thoughts about, in your particular areas that you've spoken about, because they're quite different, how we are going in terms of meeting that target for the Vision 2030, but also more specifically, I guess, how the role which Multilateral Development Finance can play in helping us achieve our Vision 2030. Anyone with thoughts?
That's a very interesting question, Nakubiana. As she mentioned, as a country, we are aspiring to be a prosperous middle-income country by the year 2030, but to achieve that, we would need to grow, and to grow at rates that are quite substantial. Looking at the current growth trajectory, Zambia is at the moment projected to grow at -4, or the economy to contract by 4.2% in 2020. Pre-COVID, to achieve that goal, we were required to grow at least above 6% per annum, which seemed to be quite challenging to achieve even at the time. To answer your question, it's going to be really challenging to achieve that level, to attain the prosperous middle-income country. And also looking at the GNP per capita that is used by the World Bank to classify different countries. We in 2014, when the country status was just revised, the country was growing at around, in terms of GNP per capita, the GNP per capita was somewhere around 1,700 US dollars. Now, as of 2019, the GNP per capita has reduced to somewhere around 1,400. So we see that we're taking a downward trajectory, taking us away to what we aspire to achieve. So that is proving to be elusive at the moment. So what can the Multilateral Development Finance do in this place? I spoke to the need to get an IMF program, for example, which will provide a sizable finance. That finance can go a long way in improving Zambia's fiscal status, fiscal savings, as well as all the resources that we need to channel towards growth-enhancing sectors. With the coming of such a program, growth-enhancing sectors will be supported. We will start registering growth, and we'll have some breathing space in terms of the fiscal situation that is currently obtaining. Thank you.
Thank you, Nakubiana, for that question on how much progress Zambia has made, or where we are in terms of achieving our own Vision 2030, which, like you put it, aims to get the country to being a middle-income prosperous nation. As I've earlier alluded to in my presentations as well, we've seen significant challenges in terms of financing the social sector, reducing the space. And when you look at reaching or achieving the Vision 2030, there's only about 10 years left. Focus for Zambia now should be around getting back to positive growth. What do we need to do? Getting back to the basics in terms of rationalizing expenditure, trying to manage our costs of debt. And this is critical because what we've observed, and this was shown in my presentation, is that there is shrinking fiscal space. Now, what this means, especially for social protection or for basically the grassroots, is as you go through an economic crisis and also as you go through basically recovering from these effects of COVID-19, there will be greater need to provide protection. So greater need in terms of the numbers that you need to cover for particularly the social cash transfer schemes and other related social protection schemes. I think this is where we sort of have a critical role in terms of MDF, what we've seen. Like I earlier showed in my presentation, at the beginning of programs like the social cash transfer, there was significant contribution from donors and partners in the actual implementation of programs. Over time, government took responsibility and took ownership of these particular programs, and I believe this was partly to ensure sustainability for these programs. But as we go through basically a recession and also dealing with the dual effects of the socioeconomic effects of COVID, it will be increasingly important for partners to come in with MDF to sort of support social protection programs to ensure that as the Zambian government aims to recover the economy or to get the economy back on track, we have significant protection for these vulnerable groups that with the crisis we risk slipping into further or deeper vulnerability and poverty.
Thank you very much, Nana, for that very important question. So in terms of the Vision 2030, we know that it's actualized through the National Development Plans. And one thing that we observe in terms of growth sectors, I can pick manufacturing, for instance. In the Vision 2030, the aim or the objective there is to grow the contribution of the manufacturing sector from the current about 8% of GDP to 18%. Now this is 2020, 10 years before 2030, and we are still within the same bounds of contribution to GDP. It's still at about 8%. So this, for me, is really a tall order. By now, we should have been perhaps above 10% if we were to achieve what's stated in the Vision 2030. Even when you look at other measures like the contribution of manufacturing in terms of manufacturing value add as a percentage of GDP, it's currently at 7%, which is minimum for a country that aspires to be a prosperous and middle-income country by 2030. So I think the onus is on government, of course, with the collaboration that comes from Multilateral Development Finance institutions to ensure that we move from where we are to what we've set out in the Vision 2030. But in terms of being realistic, it's a tall order in terms of our ability to be able to reach 18% for manufacturing. And even when you look at other goals like Agenda 2063 at the regional level, we still have a long way to go. So I think this is something that Multilateral Development Finance institutions can pick up to help us achieve what's set out in the Vision 2030. Thank you.
Thank you, gentlemen. Very interesting insights on Zambia's own ability to achieve the Vision 2030, which in many ways parallels the concepts of the Agenda 2030 and the idea of not leaving anyone behind. I've actually just thought of one other thing, and this is probably more relevant to Miselo. When we talk about, I think in his video, in his opening remarks to launch the report, Angel Guira mentioned the need for transparency and accountability in the multilateral development finance space, and in order to build sort of trust in those institutions. I'm thinking the flip side of that is building accountability and transparency in terms of the recipient countries and how they are using the finances that they are receiving from development finance. You mentioned something about some funds for the social cash transfer, which were misapplied at some point. And I guess in that regard, what can we sort of comment in that space, if you have any thoughts, Ms. Elo, on that, about how we as a nation and more generally as recipient countries, what we can be doing in order to make ourselves more accountable and, I guess, open to receipt of this type of financing from multilateral development financial donors. Any thoughts, Mr. Lo?
Thank you, Nakubiana, for your comments. Like you rightly put it, in my presentation, I had shown how in 2018, I think we had a mishap regarding funds that we allocated or provided by our partners, and these were meant for the implementation of this particular social cash transfer scheme. And this monies basically were diverted by an implementing local partner. And this raises, and like I mentioned, this raised serious accountability concerns. This also had a shift from basically donors providing government with actual funding to opting for a route to implement directly. What this also has done is it also becomes very difficult to basically track the support that is coming in externally, because our donors have opted to implement directly. Like I earlier said in my previous comments, one of the things that we expect, given our current economic conditions, is we expect more people to fall in need or be in need of programs like the social cash transfer scheme. And what this also translates into is that there will be requirement for more resources to come in. Now, for these resources to come in, the government needs to take steps to sort of rebuild trust with supporting partners to be able to commit more financing towards this particular program. Of course, we've already seen this with the emergency cash transfer, but this is only a temporal program. And what we expect is over the next few years to have or see continued support from partners through development finance. Now, what this requires, and Nakubiana, like I earlier said, is for the government to begin to take steps to improve transparency in terms of the funding, improve transparency in terms of expenditure tracking. These systems must be open so that our partners that are supporting government efforts are quite confident that the money is being provided to the government, or the support received from the government is actually going towards implementing these particular programs. But beyond that, there is also need for partners to also come in, not only with financial support, but to also come in with technical support that will help in building these mechanisms that ensure there is transparency. So basically working closer with government as they implement these particular programs, providing government support in terms of actual spending, actual reporting, to improve transparency and accountability of funds that are received through this mechanism we are referring to as multilateral development finance. Thank you.
Wow, Ms. Elo, thanks for that. And I think the big thing I'm picking up here is that in many ways, I think it's the last point you were just making, it's not just about the money when we think about multilateral development finance, but also the technical support that these institutions who provide a lot of this financing can provide to developing countries. So I think Mr. Masilokwa mentioned earlier something about how the IMF provides staff monitoring programs, and it's not, so in many ways, I guess it's not always about the money. So that's one thing I picked up from what you said, but also just the fact that we've got a little work to do in terms of rebuilding trust in certain aspects of how we spend our monies which are coming from multilateral development finance. Okay, so everyone, I think we have pretty much come to the end of our launch event, or rather the event supporting the launch of the OECD Multilateral Development Financial Report 2020. And I hope you have enjoyed hearing a bit of a different perspective, sort of at a more national level, of the relationship between a country and development finance in a few different aspects. So looking at the macroeconomic sectors, the really economic growth drivers, and also a more on-the-ground social sector perspective. Thank you for your time, and we hope that you will take a moment to read the report, which can be found on the OECD website. And yeah, enjoy the rest of your morning, afternoon, evening, wherever you are watching this from. Thank you. And thank you again, gentlemen, for your presentations.